Fantastic. Okay. Well, Eddie, thank you very much for inviting Al and myself along this morning. So I'll just let you do the start, and then.
Thanks very much, actually, for working with us on this one. So very quickly on Twitter, if you want to tweet, those are our Twitter handles. And welcome to the first of this three webinars on enterprise techs. And if you've read the descriptions, it's quite interesting on the different stakeholders that we're approaching. This one, obviously, we're approaching from the perspective of the financial institution looking to engage with vendors and wanting to ensure operational resilience. It might be useful, Alastair and Rupert, if you want to start by introducing yourselves before we move on, and maybe talking about Disruption House.
Of course, yes. So I'll start. Thank you very much, Eddie. So I'm Rupert Bull. I'm the CEO and co-founder of the Disruption House, and I'm joined by Alastair Goodwin, who's the CEO and co-founder of Adoptech. I'll let Al introduce himself in a second, but Adoptech are a partner of ours, which is why we're doing this joint series with you. So the Disruption House specialises in assessing the survivability of early stage software businesses. So we've seen over time that 60% of B2B software businesses, which really fintechs are, don't survive the first 5 years. And therefore, if you are a supplier, you need to demonstrate your enterprise readiness to those firms who are your buyers. But actually, increasingly, what we've seen is that buyers really want to understand the new and different type of risks that are emerging into their supply chain by working with innovative new providers. And that's really what we're going to sort of talk about today. So Al, do you want to take on from there?
Thanks, Rupert. So, very quick introduction. Al Goodwin, 15, 20 years in investment banking. Most recently, I was at Goldman for a period of time before jumping into fintech, where I was tasked with turning around distressed fintechs. Actually, there were 2 reg techs. So, went in, turned them around, sold them on, and then ultimately set up Adoptech last year, which is in the name, I guess the clue's in the name. It's all about the adoption of technology. And we're building a tool set to support the adoption of technology, primarily fintech. We do that by mitigating the risks of that adoption. So from a consumer's perspective, we provide something called assurance, which is, I guess, the easiest way to describe it for those that are familiar with software escrow. It's escrow on steroids. We maintain a full replica environment of a cloud service. And in the instance that cloud service were to fail, or that firm were to fail, we'll step in and operate that service on behalf of all the clients to protect them. Equally, that same environment can be used by the vendor as a BCP DR solution. That's our key service, but there's a number of tools and suite of tools around that.
Thank you.
Okay, so this slide pretty much covers what we're going to cover, but what this makes me think when I look at this, 20 years ago, I was a technical project manager in a very large financial enterprise. And I remember that we were very not invented here, i.e. we built and did everything. We had a department for everything. And in the last 10 years, fintech has really changed that. And now it's much more a case of which vendors do you want to deal with? You know, there's been a real opening up of banks in order to reduce internal costs and operational costs. So I really kind of get this. But the problem is, if you're going to deal with vendors, external vendors, you don't get a lighter regulatory touch or operational touch. You still have to meet all those requirements. So there's a whole bunch of new challenges coming. And I like the way this talks about disruption in the value chain. I think that's really happened. And I tend to think of fintech, and you know I've been involved in that for about 10 years now, as an externalized kind of R&D department now for financial institutions. So half of, or a large part of the work of a CTO today is to select vendors. And if you're going to use external vendors, you have all the problems that come with that. It's no longer internal and you still have to meet all the requirements. So I think this is very relevant right now, moving forward, because I think, the way that large enterprises buy tech really has changed dramatically over the last 20 years in my experience. And much of this now is, much of operational resilience is very, very important if you're going to deal with potentially smaller companies that don't have the kind of resources banks have. I don't know if Rupert or Alastair, you want to comment on that?
No, I think we'll sort of come on to that through our sort of conversations as we're going onwards. I think it probably segues very nicely into some historic perspectives on Al that I think you've spent a lot of time looking at.
Yes, absolutely, and I think we'll touch on them. In fact, it's probably a good segue into that. I guess the first question, Eddie, if you just want to move on to that.
So I think so. We're going to structure this discussion around a series of questions, and we'll see if anyone's got any comments. And the first one is, of course, I believe it's just a quote from Warren Buffett. Are the businesses you rely on to deliver your business swimming naked? Is that Warren Buffett?
Yes.
Oh, yeah, okay. So what's your comment on that, Alastair or Rupert?
Yeah, so it's a quote I love. Warren Buffett's used it many times over the last 4 decades. Actually, each time there's been a large economic downturn, he's referenced it. And it's really it's his actual quote. It's only when the tide goes out that you learn who's been swimming naked. And the point he's making is that you only really find out, where firms where highly leveraged firms and poorly capitalized firms present a risk to yourself. You only find out when the tide has gone out, and that the tide has gone out when we come again, in this time probably faster than anyone expected in relation to sort of COVID, and we're very quickly going to find out which of those firms that we're reliant upon to deliver our business are swimming naked. Those particularly that are reliant upon the next funding round. We'll very quickly find out, whether they're going to be struggling or not. I think it's probably worth mentioning here that I think in our conversations, and I'm sure Rupert will agree that in our conversations with clients, it's pretty clear actually that most firms can't answer this question, and it's a question all firms should be asking themselves. Do you actually know where your risk lies? Do you know the state of the vendors that you're reliant upon? And most firms, from our experience, aren't asking the questions. They're not talking to firms anything beyond sort of post-procurement. You do a very long post-procurement, typically 12 to 24 months procurement cycle, after which there's very, very little oversight of those vendors, even though those vendors can be providing some quite critical services to the banks and asset managers. And it's quite surprising to us in that you would be that reliant upon a firm, but you wouldn't be talking to them regularly. But that seems to be very much the case today. And we're not the only ones to have noticed it. The regulators have clearly picked up on this. And even prior to COVID-19, there's been a huge emphasis from the regulators on not so much financial risk, but non-financial risk, and particularly outsourcing and operational risk, which we'll touch on a bit later. But yeah, we're not the only ones to have noticed this. And I think changes coming as a result. Rupert, any thoughts on that?
Yeah, I mean, it's probably just worth. There's a report published by the Startup Genome Project, who are out of California, and they've been involved in tracking the startup ecosystem. Really, I think probably since about 2011. So they've got about sort of 9 years worth of studies that looking at the whole startup ecosystem, and they conducted a survey. I think probably about late March, early April, of startups globally. Now, I think it probably has a slightly American bias because they're based out of California, but clearly there's many more tech companies that are born out of California, say as a proportion. And what they found in the survey is that 65% of all companies who responded, including 34% of those who've raised money at Series A and later, have less than 6 months worth of runway. 74% of the respondents had to let go of full-time employees, with 26% of them having to let go of 60% or more full-time staff. Okay, now what that means is, the companies are adapting, but they're not going to be able to meet the SLAs they're committed to. So I think this whole thing is coming into, and nobody, to pick up on your point, has a systematic way of rapidly talking to their supply chain in a post-procurement way. So I think what we're seeing is that there was generally an assumption, because it was a benign environment that everything was growing, that if you've been funded by a VC, you were fine, and you get your next round of funding if you were keen to do stuff, and if you sold good stuff, you'd be all right. And actually, what we're seeing is that the funding environment has changed dramatically. Many GPs are funding their LPs are saying, actually, please pause investing because we need to conserve cash for other parts of our business or other things. So it very much is. There's an awful lot of swan syndrome going on, and I think on the surface, it appears fine, but you actually do need to be diving in quite quickly, and I think the stats are proving it.
Okay, would any of our guests like to make a comment on that? Does anyone put their hand up? No? Okay, well, shall we move on? The obvious question about COVID, obviously COVID-19, how's that affected the operational resilience? Alastair?
I mean, I'll sort of happily start sort of just with kind of what we're seeing in the marketplace. I think, Al, feel free to jump in. So I think it's having an impact in two ways. I see it. One is that the firms are very much focused initially on sustainability of their operations. So things that were historically done in the office and on premises, people have been rapidly working out how to do that working from home. So that's be to enable traders to trade from home, or to enable back office processing. I mean, a small number of staff are going into the office in these times, but most functions have been successfully migrated to home working, which means that people have been rapidly, I suppose, doing things like upgrading to Teams from Skype. And we're using Teams this morning, and we've now just learned that it doesn't work so well with Meetup. So we'll next time look at GoToWebinar. But you're seeing all these kind of digital tools that are massively being accelerated to enable people to carry on doing some things before. But I think there's really probably two areas that I think are critically important: cyber and security. And then I think also just to some extent regulation. I mean, people are working from home. Traders are able to use mobiles. You had controls on the trading floor. So there's a set of things that actually people are trying to work out compliance in the new world as well. But I think broadly speaking, it's working. I think the challenge is, though, that in order to get working, people have onboarded a lot of vendors to help them who are small and young, who they're not actually doing pre-risk assessments, nor have they got a post-procurement process in place. So actually they're kind of accelerating risks into their organization based on the stats I just gave, and actually not measuring it because they're so focused on just the here and now. So I think that's what we're sort of seeing, is this sort of mitigating day-to-day risk in terms of just keeping going, but actually introducing supply chain risk by not actually having third-party risk management processes in place to deal with it. Okay, Al, would you add anything else to that?
I think from my perspective, it's clearly banks have, I think, on the whole, done very well, and I think that's largely due to 2008 and the changes that were enforced and that came off the back of the financial crisis in 2008. I mean, banks have managed the financial risk far better in this, I guess, downturn, simply because they aren't taking as much risk, and there's processes in place to ensure that they are in a better place for this type of economic downturn. So I think on the whole they've done well. I think clearly there's been a focus since 2008 on financial risk, but where there hasn't been much of a focus is on non-financial risk, and as a result, that is where we're likely to see the greater problem. So, for example, we know that a number of banks that outsource to regions that are ill-equipped to handle the sudden upsurge in home internet consumption are struggling. So particularly operations functions that have been outsourced to particularly India is probably a popular destination, but the broadband in India is not great in certain regions. So a number of the staff have struggled to work from home, and they've, as a result, struggled to deliver their services. We know the regulators are looking at that. And you can expect that there will be a great focus on that element of outsourcing following this. It's broad. I mean, I think if we look back in history, I think you can see that each time there is a large economic downturn, it does drive and force change, and in turn, adaptation and innovation accelerates. If we look back to 2008, it's no exception. The financial crisis came. The financial system came to a meltdown with highly leveraged banks being bailed out and the recession following. But that resulted in significant change. There was a raft of regulation, and there was also the economic impact. So the raft of regulation, we're all familiar with it. We've all lived through that since 2008. And the economic impact had a big change, particularly in technology, because there wasn't quite the money anymore for the banks to throw at technology teams. So, and also there are large technology players coming that could compete for the technology talent. And what that meant was there was greater demand for low-cost, innovative technology solutions. And these things called fintechs appeared, thousands of them. If you think back to 2008, we didn't really talk prior to that in the same way about fintech. And that's a direct result of the financial crisis. And that drove the demand for fintech. Now, the implication of that is that a lot of the firms that were directly regulated, the banks, the asset managers, were effectively passing a lot of their operational risk to third parties, but those third parties are not under the same regulatory obligations, or at least they weren't until recently, and we'll touch on some of the regulations shortly. But I think on the whole they've done well, but clearly there hasn't been the focus on non-financial risk, and that's what I really expect to be the big outcome of this this economic downturn.
Alastair, can I just ask a question? Do you predict in the next 6 months that there are going to be some major failures, major issues with some of these smaller companies? Is that going to come out?
Well, it's interesting actually. We partner with an insolvency specialist called Leonard Curtis. Talking to them, they haven't seen an uptick, a great uptick as yet. There hasn't been a spike. What they have seen are firms that were already in trouble prior to C19 are now sort of bailing out. But what they expect, and it's a historical fact, you can see the number of insolvencies increases as you come out of a recession. So I don't think it's going to be immediate. Most firms can sort of batten down the hatches and survive for 6, 12 months. There will be some that, as we said, are reliant upon the next funding round, but I think the majority will be able to survive a period of time. But the question will be, can they adapt and change quickly enough and get the funding in as we start to come out of the recession? So I don't think it will be next 6 months, but I suspect, it's going to be 6, 12, 18, 24 months when we really start to see some, particularly the larger sort of firms that might be impacted. So people have got, I guess the key point is that people have got time to react to this. If you do something about it now and start thinking about the implications, then you still have time. And the most important thing is to start start communicating with those vendors and understand where those risks are to give yourself the opportunity to react.
Does anyone else have a comment? Would anyone else like to interject? Okay, shall we move on to our next question?
Yep.
So, what regulating mandates or risk should firms be considering?
Okay, I'll take this one, Rupert. I will promise not to drag this out for too long because, as I mentioned, we've all had 12 years of regulation following 2008. As I mentioned, the regulators are absolutely focused on operational resilience. The FCA have made it clear that operational resilience is viewed as no less important than financial resilience, and it's a big focus for them. They are working on a consultation at present, which has been extended actually till October, but it will be implemented over the next 3 years. We expect the final regulations to come into play next year, and then for it to be announced next year and kick in 2022, but it will be implemented over a period of time. Though those sort of, I guess it's probably worth touching on, I guess the key elements of the FCA consultation are really around ensuring that you have categorized each of your firms and that you are monitoring them, and you've got appropriate programs in place to manage that risk. And what I'll do actually, rather than I'll share with everyone a quick sort of summary of that FCA consultation and what the expectations are of the back of that. Initially, it only impacts a couple thousand firms, so it's mainly the larger firms, but they are intending for those rules and regulations on operational resilience to be extended to the wider financial services community over time. Perhaps more relevant is the Eba Guidelines that were live in the 30th of September last year. They harmonized a bunch of regulations across Europe, including cloud regulations on outsourcing to the cloud. Say they went live 30th of September. The key elements of that are that you need to have a sound outsourcing policy in place. You need to maintain an outsourcing register, so effectively a list of every outsourcing agreement you have in place, and you need to categorize each of those firms within that register. And it's particularly important if you determine that one of those are what they can call important or critical. You need to then carry out far greater oversight on those firms that are providing critical or important functions. You need to carry out pre-contract due diligence, and risk assessments need to be carried out. Vendor contracts should grant firms and regulators unrestricted rights of inspection and auditing. And this is a key one. This is really where what the regulators done is said, Okay, so you're effectively outsourcing this risk to third, fourth, nth party firms, but we historically have not had access to those. As under these guidelines, the regulators can go and audit these fintechs directly, so they can knock on the door and say hello. And that's a big change, and that's probably the most significant change. And particularly for the fintechs, it means that they effectively need to be meeting similar standards to the financial services firms that they're supplying, both in terms of technology security and ongoing governance. So there's quite a lot of overhead that the banks are familiar with and have been for a long time that the fintechs now need to be supporting. You, as part of the EBA guidance as well, you also need to be maintaining you need to periodically test BCP plans for those critical or important functions. You need to have a step-in plan in place, so you need to understand what's going to happen if it goes wrong, not just to the firm, but if they were to fail. You need to have a clear plan in place for that. And you also need to, one of the bits they highlighted, actually both the EBA and the FCA have highlighted concerns around intra-group outsourcing. So if you think particularly where your firms, where they look back to head office that might be somewhere in Europe or abroad, they have made it very clear that the fact you are utilising group services doesn't mean that you don't have to uphold the same level of oversight as you would for an external third-party provider, and they really have focused on that, and I think that will continue. So, you know, talked recently to a firm based in Canary Wharf. They have an office here, but their head office is in Europe. All their technology, 99% of it is from group, but they now as an entity need to carry out the same oversight on their group as they would if it were an external third-party supplier. So I think they're probably the key things to say. I'll leave it at that. I'll send. We'll share some overviews of both the FCA consultation and the EBA guidelines after this. Rupert, Eddie, any questions on that, or anyone else?
I suppose, I mean, just you sort of flew through it in passing about the difference between cloud services and because of the consolidation, and whether you think there's well, there are, but just, you know, what your thoughts are on the key differences that people should be aware of.
So what are the how are the regulators are approaching cloud services? Is that the question?
Yeah, cloud-based services, how they bring cloud-based services. Yeah.
So there was a lot of debate over this a few years ago, and the output of that was in 2017, the EBA again made some recommendations on cloud outsourcing, which were incorporated in this latest version of the regulations. And really that was just to clarify whether or not it was considered okay to be utilising these cloud services. Well, we know now that the regulators themselves are utilising a lot of cloud-based services. They're fine with it. The point is, it sounds kind of obvious, but you need to understand the risks, and that's actually what the guidelines outline. It sort of basically starts with understand the risks, which sounds obvious, but they're keen to ensure that people are actually doing that. And I think the other key point, obviously, with outsourcing to whether you're using a cloud provider like AWS or a service provider who's hosting their service on AWS or Google or any of the others, is that it's not just the potential of losing the software, it's the potential of using your data. And that's the big focus in the sort of 2017 recommendations that the EBA put out. It's largely around data security and ensuring that if there were to be a failure, that your data is secure and that you've got the appropriate security in place to ensure that data remains secure. So that's the real focus. That came out 2017, to say it was adopted as part of the latest EBA guidance. And again, I can share some. It's probably worth me sharing some information on that after the call.
Great.
Alastair, I just have a quick question. How does the enterprise extend its regulatory boundary to include this fintech startup? Because at the moment you've got a fintech startup, the enterprise probably wants an on-premise solution. Escrow is straightforward, and you don't get involved. You meet their requirements, but it doesn't extend to you and then to your stack, which might be a stack of open source and other products or whatever. So what is this, a legal contract? How do you do that? How do you extend that boundary to include the startup and also the companies they rely on. And nowadays, it's all, the stack could be a whole bunch of stuff.
So the expectation is that those fintechs will be carrying out the same oversight on their third and fourth parties as the financial service firm. And interestingly, actually, what the FCA look like they're likely to do, as I mentioned, you should all have an outsourcing register now, which details all the firms that you're reliant upon, all the firms that you have a contract with, and their criticality, and where they're important or critical. You should know their third and fourth parties as well. So you mentioned you're reliant upon others. They should all be documented. What the FCA look like they're going to do, the UK FCA, I should add, they look like they're going to extend that, and because they are talking about, they want an analytical method of understanding the supply chain for financial services. So what that will mean is that outsourcing register, I'm reading into this, we're actually going to chat to the FCA about it next week, but what I'm reading into this is that they are going to ask for everyone to send their outsourcing register in a standardized format, but also the third, fourth, and nth party where it's considered important or critical. That will be sent to them so that if an event happens to X fintech or a certain firm or a certain thing, they can very quickly establish who's reliant upon them. Did that make sense? So effectively, yeah, they're going to outsource the register.
A lot of extra work. It's a lot of extra work for the fintech. Does anyone else have a comment? Sorry. I'm just mindful of time, so should we move on to the next one? We will send out some more information about this.
Yes, please. Let's go.
I've got a quick question, if you can hear me.
Yeah, James.
Can you hear me? Yeah. Hi, hello. I'm James Hughes here from Rick. So, with you've got the regulations that can the regulators can audit the fintechs can audit their tech cloud providers. Now, if you've got from our experience, and we work a lot with these sorts of things, we're seeing, broadly speaking, every fintech pretty much using the same cloud. What do you think the regulators are going to do there? Are they going to break up the cloud usage or enforce it that everyone can't be in the same cloud, or what do you see happening there?
In my view, I think it's very unlikely that the regulators would try and enforce that. What they will do, and I'm sure this has been a hot topic for a long time, is the concentration risk. But I think actually, at least from what I've seen, I think firms are starting to adapt to that. People know that's coming. So I know it's harder in practical terms, technically, than in theory, but most fintechs we're talking to are at least talking about becoming cloud agnostic so that you can fail over from, let's say, AWS to Microsoft Azure, which typically the two. Sorry, carry on, James.
I don't want to disrupt it, but that sounds very good in principle, but in practice it doesn't really work, and we don't actually see it alive and well. It's the same in the asset management space. There's an awful lot of money concentrated on a single platform called Aladdin. Something like $6 trillion. I feel like the regulators are going to be looking at this closer. I just wondered what you thought, because the marketing of bouncing between clouds all sounds very good, but practically that's not massively practical. So I wonder if the regulators are going to step in and do something. I'm just generally sort of spitballing, seeing what your ideas are.
I entirely agree. I mean, from having run a couple of regtechs recently where we talked about becoming cloud agnostic, as soon as you actually start to try doing it, it's actually quite challenging. It's not as straightforward as people suggest. So I think it will be difficult. I suspect over time it may be, enforced by demand. If your clients insist upon it, because the regulators are insisting that there's too much concentration risk, you may be forced to find a solution. But generally, I presented to IOSCO, which is kind of group of regulators, global group of regulators. It's an annual sort of conference, and every single time the questions they're asking me are around concentration risk, and each time they're asking me whether or not some were actually feeling whether or not they should start to regulate some of the technology firms directly, and that came up frequently. But I think everyone agreed that it just wasn't practical for the regulators to start directly regulating some of the large providers, such as, whether that's from a market data provider like Reuters and Bloomberg, which was the sort of conversation at the time, or whether that's an AWS or Microsoft Azure. What we have seen from those Microsoft Azure and AWS is a lot more they've opened up a lot more and they understand the financial services space a lot better. They appreciate that they're under these regulatory mandates, so they've been a lot more open to audits, to provide the regulators with some, I guess, transparency and some confidence. But in terms of, I cannot see how, that's not to say it won't happen. I think it'd be very difficult for the regulators to insist on breaking down some of these monopolies. They talk a lot about concentration risk and making sure that you don't have it, but to actually intervene, as you mentioned some examples there are many others where everybody has just started to use the same service provider. I think it's, I'm not quite sure how they'll go about breaking down those effectively sort of monopolies in those spaces. I don't know, what are your thoughts, James?
I think fundamentally, if these cloud providers become part of the core national infrastructure, and if the core national infrastructure is all largely with either 3 providers or, maybe in Amazon's case, just 1 provider, they'll be forced to do something. Yeah. So my high level I haven't gone any deeper than that, but I just suspect something is going to need to happen.
Yeah, you are seeing, the competition authorities starting to get involved, that we saw in a recent case actually, where one large vendor wants to buy another vendor. So I think concentration risk is becoming, just across all technology, is becoming a concern to the regulators, and it will, how they solve it, can't tell you at the moment, but it does feel to me that it is a prism they're starting to look at the market through, in terms of market share, too much market share in a single provider.
Okay, shall we move on to the next question? I'm again mindful of time. So you can read it. What steps do you suggest firms take to support the adoption of fintech whilst protecting their operations from risks that introduces? Rupert, Alastair?
So I think there's sort of 4 phases, and I'll kind of let Alastair jump in at different points. But I think at a headline level, what we see are, you need to review your kind of risk register. You need to assess the risks of what's in there. You then need to sort of have a plan to design a response, and then you kind of need to be implementing on it. So I think we see at a headline level sort of a 4-phase approach. But Al, do you want to you spent quite a lot of time thinking about the sort of review process and talk to that, and also come back to the assessment piece?
Yeah, absolutely. So I guess it varies obviously depending on which firm we work with, but typically it's a process where we review, what's in place today. I mentioned the outsourcing register, making sure your outsourcing register is up to date. Then we'll go through an assessment to determine the risks that each of those firms within your register present. And then we'll look to, what actions need to be taken, and ultimately, how do we improve the process and react to things so that we emerge stronger going forward. So they're really the sort of 4 steps we typically go through. I think just with the review, as I mentioned, let's just start with the review. Update your outsourcing register. You haven't got one, you should have one. Make sure it's up to date. The clear point there is that firms will be in your outsourcing register that weren't there 3 months ago as a direct result of COVID-19. Rupert, I think you touched on some of them earlier. There's a whole bunch of technologies that you are now reliant upon. Things like trying to get an approval for e-signatures and things like that for certain firms is a real challenge. Those type of things should potentially now be in your outsourcing register, and they should be assessed as to whether or not they're critical. Can you easily flip to another solution? Can you not? Then tier and profile those. So it's best to use a sort of pre-agreed classification model. There are a bunch out there. We've got some. It's really just to give you a standardized way of tiering each of your firms, so that bias doesn't come in and you get the best results out of the process. It's things like remembering that the size of the vendor doesn't actually determine the risks that they pose. A tiny fintech with 3 people might be providing a microservice that's critical to your environment, but you're focused on AWS or a Fidessa or Ion, and you're focusing too much on that rather than the risk they present, which is really where you should be focusing. And then we typically go through an assessment. I don't know, do you want to, Rupert, just touch on that?
Yeah, so I think there's obviously different levels of assessment. I think what we've focused on is really, what we've seen is people have historically focused on, is this a good thing? Does it solve a problem? Is it doing trade surveillance well? But actually forgetting that it might come from a 3-person firm, as Al has described, and actually that you within that, all 3-person, let's go to 50 people firms rather than 3 people firms, but all 50 people firms are not made equally. And I think that a 50-person firm could be full of engineers who produce brilliant technology, but actually if they've grown quite well because they've had an early client who's adopted from an engineering perspective, B2B software doesn't sell itself. So unless actually there's a real focus on building the business, actually what makes a business sustainable is the business wrapper. And the business wrapper is made up of people. And in the way that, James, you mentioned the asset management industry, when it looks at making an investment in a listed company, it looks at the leadership team and the skills they bring to do that. And actually very often people just look at, are these guys subject matter experts? Do they understand my problem? And forget that actually if it's a 50-person business, it's actually it's an entrepreneurial high growth business, and they need to be doing very different things. So I think you need to look at the leadership team. Do they know how to build a business? Have they built one before? If they haven't, have they got advisors who have? Are they open-minded? Are they aware of the risks that they're running? And and how do they react being told that there are risks? Do they respond positively and go, thank you, that's a gap I didn't know about? Or do they go, get the hell out of here, who are you to insult my beautiful baby that I'm building, right? In which case they are a higher risk, right? So you can't take people out of technology. It's very much a human thing. So I think what we do is provide that initial assessment, and then by benchmarking people against each other, within either the portfolio of vendors that you have within your firm or actually against others, you can see the ones that need further investigation because there may be deeper risks or they need deeper support. And I think that's really the journey we go on, and that's where we go on in partnership with you, Al, in terms of getting into understanding the business, so that you can start to assure it if it is a critical vendor, so you want to ultimately mitigate the risks overall. So I think it's some things that are firm specific and other things that are market context, and I think an assessment should cover both of those, and that's what we do. And then I think when you get through that process, you end up with a set of choices. If a vendor is getting into trouble, you have only one of 4 choices, which is you can internalize it. But if it's if it's a process that you have no internal skills, then that's not an option. Or you can invest in it. But if you're investing in it, are you investing in it for the long run because it's going to grow, or are you just buying yourself time? And I think you really need to understand that, because you can throw an awful lot of money after something that's just going to consume it and not grow. So if you're buying yourself time, then actually you need to think about alternatives. So then you need to go into a market landscaping. What's the alternatives? And that's actually the what I was referring to earlier is in the EBA guidelines, is you've actually got to have replacement plans in place. You've got to know, are there options? What are my options? Is it to internalize? Is it to give it to somebody else, etc., etc.? So I think that's the nature of the way we see people being presented with responses, what they can do, and then ultimately there is the assurance piece. And now, if you want to sort of talk about that a little bit more, it becomes part of your response strategy. We feel.
So just touching on assurance. So I think sort of in the intro, I gave a quick overview of what we do, but effectively it's an extension to software escrow, where we maintain a replica environment for a service, and if that service fails or the firm pivots or goes bust, then we step in to operate that environment on behalf of all the clients as an independent middleman for a period of time, keeping the lights on, so that the firms using that service have time to migrate to an alternative or resolve the issue with the firm. It's kind of an extension to software escrow. We kind of consider it a practical working version of traditional escrow for cloud services. The only other point I'd mention in this kind of process, Rupert, is that clearly right now there is a focus when you're doing those assessments on the financial and cyber risks. Just the nature of this pandemic, clearly there's going to be financial impact, and also we know that the amount of the cyber risk has increased. So in all the sort of assessments that we suggest to firms they should be carrying out right now, they should be definitely prioritizing sort of the focus on the financial health. What's the runway of the companies that you're reliant upon, and also how secure are they? So that's the only other point I don't.
Yeah, Fantastic. So I think that that hopefully gives a view of the things that are possible. And Eddie, anything else you'd like to ask at this point, or anyone from the audience?
Oh, I'm fine. Does anyone else have a question or a comment? So shall we move on to the next slide? So this is an interesting one. What are the key points you think you would like people to take away from this discussion, chaps?
Who wants to go first? I'll go.
Well,
Okay.
Yeah, I think overall, it's probably that operational resiliency, and in terms of as a regulated firm, is becoming a higher priority. So I think we will expect to be talking about this more over time. I think it's very early for many firms, and I think one of the interesting things that we saw in some of the FCA letters that went out to dear CEOs over the course of the early part of the year is that actually your own ability to stay sustainable yourself is that you actually have a sustainable business model. And so I think for what we've seen is that many of the cost structures of banks, asset managers, brokers were predicated on business models that that have been around for some time. And I think what we're seeing is that they're quite high cost, and they're quite high cost before coming into this crisis. But actually post this crisis, when revenues will be dropping because customers, your clients will have less money and be doing less business, that actually you need to think about getting your own costs down. And to do that, you're probably going to have to do more with cloud native solutions, which are going to make you have to think about your supply chain differently. So I think it's not just about operational resiliency. I think it's the way that you yourselves think about your own sustainability businesses are probably going to accelerate the need for digital transformation, and that's going to mean that you need to be thinking about the suppliers in a different way, and that the established procurement processes really weren't designed for this supplier group, and therefore it's probably time to think about these things in a holistic way and talk to your procurement department and get them involved alongside risk. That would be my my thoughts. Al?
Yeah, so I agree that I think the key point I think that you made there is that the way in which people think about sort of risk management, I think, will change and needs to change. And that's even from the outset of it. If you think of internal audit, I know when I was working within sort of financial service firms that if we, an audit point was raised against something that we were responsible for, that was a bad thing. That was really because, oh no, we're going to have to spend all this time, resolving this audit point. I'd rather be focusing on, building out the trading platform that's going to earn us some cash. That's kind of, I think, concept needs to change. Identifying gaps, so whether they're audit points or otherwise, it should be considered an opportunity to change for the better. I know that's easy to say, but I think over time people will start to see it like that. That actually these gaps and filling them and improving it's a good thing, and it's a potential to make money and improve your resilience, which is key actually strategically to the company. So I think people will start to think about third-party risk management differently. We don't in financial services think about supply chains. If you think about manufacturing processes, from the very outset, you think about supply chain and what happens if a particular part doesn't arrive on time. We don't think about, because we're providing services, we typically don't think about what happens if this piece of my service that's provided by this FinTech breaks. We just don't think of it like that. And what happens if their suppliers? But I think that supply chain understanding will definitely change. And I think that's something we'll see. And I think in terms of key points to take away, it's for me, well, if you act now, I think you still have a lot of time to put in place and mitigate a lot of the risks that are likely to occur. And we've seen through history what's likely to happen. We know there's going to be a funding downturn. It's already started. We know insolvencies are likely to occur later on. So act now. There's still time to put in place and mitigate a number of these risks. But, the conversations we're having with vendors, they're not being asked the key questions. They're not even being asked, how have you responded to a pandemic? Or how's your working from home policy? How's the data security? How much cash have you got in the bank? how long are you going to survive at this rate? And it surprises me that firms aren't asking those questions. And I think if they do now, they will save themselves a huge amount of pain in the coming few years.
Okay, great. Does anyone else have any comments or questions to ask?
Yeah, this is Lucy from Cioda. My question is, how do you see that the process for acquisition of FinTechnology within banks or financial institutions is likely to change as a result of this? I mean, we've talked about, what you do with the technology you already have. The kind of logical extension of that is you start to look at how you bring in technology. And we've also said that because of a focus on cost, there will need to be more fintech brought into these institutions. So how do you see that changing? Is it going to be some of this stuff is going to be less of an afterthought for procurement? Is it going to become something that comes, close to the beginning of the sales process? What do you see changing?
I think it's really the fact that it's becoming a non-financial risk that people have to care about. so I think procurement departments are massively stretched anyway. They and they've been targeted with taking further costs out. So I think they're not well set up to deal with the volume that's coming through. So I think you're going to they're going to have to go and have some strategic conversations about getting funding to do things in an automated fashion, particularly if the FCA is going to demand this. So I mean, where I'm seeing it at the moment is it's really the operational, so a non-financial risk department that is really starting to lead with this, because it's actually sort of becoming some, I suppose, things regulators care about and things regulators will want people to start to report on over time under the SMCR regime, etc., etc., etc. So I think it starts with risk. It's clearly going to be therefore fed into the sort of first line, second line of defence processes, which means that it is going to get into pre-procurement, I think, quite rapidly, and that will probably change the way innovation departments work, etc., etc. And I think when we have conversations, we're trying to encourage the risk and finance departments to be talking to procurement departments, but they're not very joined up at the moment. So I think we're just at the start of a journey, and like most things, it will probably be driven by the regulatory side of things. But I think for suppliers, being able to demonstrate your enterprise readiness will help those procurement departments to say that you've been, you've got your house in order. You look at these things, you know what they're looking for. So I think there is, and actually that's some of the theme of next week's webinar, is actually kind of what you can do as a supplier to prepare yourself. But yeah, I think my view is it's starting with risk. I don't know if you have a different view, Al.
So my thoughts, I mean, there's been loads of articles out there about, the negative aspects to fintech, but also there've been a number about the positive aspects. The current pandemic accelerating digitalization. My personal view is that it's definitely a positive thing in terms of the adoption of technology. I think it will, as have previous economic downturns, it will accelerate the use of microservice providers. And I think, we've spoken to a number of large banks, and they are actively looking to increase their adoption. Of course, they still remain hesitant, but I think the point I keep making is that it doesn't have to be hard. There are solutions out there that can mean you can manage that risk in order to increase that innovation quickly. So yeah, overall, I think it's going to be a positive thing for the adoption of technology. I think banks will very much start relying upon small microservice providers that are very good at niche areas, and I think that will become the norm. And if they don't, most, to be frank, competition will drive that, and they will be forced out of the space. I don't think the reg will absolutely push it, but competition and the revenues will equally drive the adoption of technology, because they simply won't be able to afford to not start adopting more modern, innovative technology, because the client service just won't be good enough. So.
Okay, so our final slide there is is a summary. Does anyone have any final closing comments, Rupert or Alastair or anybody else?
I think hopefully we've covered all these points already, actually. So any last questions? Conscious of time, and the top of the hour is emerging. So. Is there a question emerging?
Darren's asked a question, will the recording be shared? You have the recording, Rupert.
I have a recording, so I think what we've done with previous ones is record them and make them available. Just make sure that if anybody wants to be anonymised in their question, to let us know. We have the ability for one of us to do a voiceover of the question so that it can be anonymised. There's because we're on Teams today, there needs to be some editing, because actually you can't share I've learnt a video recorded on Teams with somebody outside your organisation. So we will take it through an editing process, and it should be available in a week or so's time, subject to other things.
Could we just flip to the feedback slide, if you don't mind? Well, we've got one more slide. There's a picture of you guys, and then.
Yeah,
so very quickly, could I ask you to, if you've got any feedback, either let me know now or email me afterwards. This was a first webinar. We've normally, those of you who know us know we've run over 200 events now, physical events. This was just our first webinar, and we'll probably be developing this further, except for obvious reasons. If you have any feedback, let me know now, or just ping me afterwards through Meetup or directly. And then finally, we have two more. This was the first of a 3-part series. The next one is next Wednesday at 11, and then 3 weeks' time, the 1st of July at 11 a.m. we'll be covering off, as you can see. The second one will be really from the perspective of the regulators and pandemic, and then the part 3 supporting portfolio companies and so on. So other than that, can I just say a big thank you to Rupert and Alastair, and to those of you who've joined us. We'll send out a follow-up email with some content and with links to videos and so on once they're all published. And that's pretty much it. Lucy,
thanks everyone.
Next week's very much for you, Lucy. Okay, thank you, everyone.
Thank you very much.
Goodbye.